see you all. And on moments, so we've got Tonga, I saw Australia, I saw all over the place. So it's the most interesting part of this business is that I get to meet people all over the world. It's a really phenomenal, side part of this business that I didn't anticipate when I started it. And now we have literally thousands of members from all over the world. And I have relationships. I've known some people for over 5 years now in some of our different funnels. All right, we have almost 160 participants, now over 160 and climbing. I'll give this another 30 seconds or so just to let everybody in, get settled, and then we'll get started. Dwight, you're live streaming this on YouTube?
Get ready to do that. With regards to storytelling.
Dwight?
Hey, Mark. Yes, we are live on YouTube.
Okay, maybe you can put that link in there. So, if you guys are having problems with your browser or what have you, you can always monitor this presentation on simulcast on YouTube. All right, so why don't we get started? Welcome to this 3-day live trade execution webinar series. It is live in real time. It's after the live markets, but it is a live presentation. I've subtitled this, How to Capitalize on Monster Moves in the Markets and Also Avoid the Market Traps. My name is Mark Shawson, the Pattern Trader. So I see so many familiar names, so many people who are already part of the Pattern Trader team and family. But for those of you who don't know who I am, I'll just give you a brief introduction. I've been trading for many, many decades. So I'm a real trader. So I do give back. I do teach people how, to look at analyzing the markets exclusively based on price action. But at the core of it, I'm a trader. I love the markets. I love the challenge of the markets. I love seeing how my methodology works in the markets. And to me, it's just a constant and dynamic process and, something that you never get tired of. But I've been doing this for a long time. And, I initially started when I was a young lad in college. I was in my second year of the University of Southern California, one of the best business schools in the country. And I was being taught on how to analyze investments from what we call a fundamental standpoint, where we look at a company and you look at the price earnings ratio and you look at the balance sheets and you look at the cash flows and you look at the EBITDA and you look at the management. And these are what are called fundamental metrics, where you break apart that investment. And that's a Warren style Buffett of trading. And that's fine for some people, although this market environment has really exposed the trap of buy and hold investing. In my email yesterday, I showed how Disney is now trading back to where it was in 2014. So think about that. You've been holding something for 8 years and it has shown a 0% return. So buy and hold investing, a little bit of a canard, a little bit of a myth. You have to own the right things. Instead, I look at how the market works on a price action basis. So when I was in college, my dad was working with this investment banker. My dad had this drive-through safari park called Lion Country Safari. And he went to an investment banker to raise him a whole bunch of money for that enterprise. And he was associated with Graham Loving, who was affiliated with this investment bank. And Graham, in addition to trading the commodity, in addition to his day job as an investment banker, he was also actively trading the commodity futures markets. Now, these are really exotic markets, everything from cocoa to live hogs to frozen orange juice to soybean meal to wheat to corn to T-bills. Literally, he was trading about 20 markets at the same time. So me trying to study fundamentals, I was thinking, how can you understand one market, never mind 20? And these are most exotic things where you have to, understand the export import ratios from Ghana to determine cocoa prices and what have you. But Graham didn't care a whit about any of that. He just basically took out a piece of graph paper and plotted an X and a Y axis. And every day he would kind of plot the closing price of live hogs and soybean meal and gold. And over about 3 weeks, those lines were either going up or they were going down. And he basically said to me, Mark, I basically want to just buy a market that's going up or sell a market that's going down. And to my, simple mind, that really resonated with me. I'm a very visual person. I'm a very aesthetic person. And so ever since that, I have been building my own way of visualizing the markets based exclusively only on price patterns and price action. So, you go into, any business channel anywhere in the world, the discussion is, are we going to go into a recession or are we not? How hard is the recession going to be? Is it going to be a soft landing? What's the Fed going to do? How high is inflation going to go? Have we reached a bottom? And to me, all of those answers can't be analyzed. You can't look at a market and come up with an answer. But the simple premise is the markets actually tell you where they want to go. Now, I will share with you a couple of emails that I sent out at the beginning of this year. And, I'm just going to read it aloud for you for just a second. So this was sent out February 14th, 3, 4, 5 months ago. And the title of this email was, my title was Dead Money. And, to me, dead money is defined as an investment that has shown little or no growth over a protracted period of time. And I said, pursuant to this definition, I believe for at least the next 3 to 6 months, and remember, this was 3 to 6 months ago, you're looking at most US stocks, tech stocks in particular, as dead money. I said, over this period, investors are unlikely to see positive returns, and this is going to be the best case scenario. I said, while I hesitate to be an alarmist, in this case, I am clanging very loudly the alarm bells. For many years, investors have been rewarded by maintaining a buy the dips mentality as stocks and indexes have hypnotically climbed ever higher. This has bred a dangerous complacency. Now things, namely the Fed, have flipped dramatically. With respect to most tech stocks and indexes at large, I strongly suggest adopting a sell the rallies approach. Based on prevailing very bearish price patterns in stocks and now indexes, stocks are likely to get decimated. Accordingly, I see a very real possibility mainstream investors could see trillions of dollars of their equity wiped out over the next 6 months. So was I right? Was I wrong? Let's kind of take a look, right? Picture's always worth 1,000 words. Let's blow this up here. I just found this graphic a few days ago, so this is very current. And consistent with my analysis 6 months ago, this chart confirms this has been the greatest era of wealth destruction in modern history. So this was 2009, one of the worst economic downturns we've ever seen. This was the COVID low, and we've exceeded all of that. Now, this is a combination of both bonds and stocks. So we have had the worst start to the year ever for bonds and stocks. Typically, the worst market for bonds has been down 2.9%. This year, we're down 11% in bonds. And so this is a combination of stocks and bonds. And so we've eviscerated $15 trillion and climbing. And I do not think it will end soon. So people think, well, we've had this incredible carnage. We got to be closer to the bottom. And to my mind, the market is going to keep ratcheting a lot lower than most people think. Now, again, this isn't based on a visceral feel or an opinion or what have you. I'm looking at just very simple charts. Let me just get out of this for a second. So this is the S&P 500. And we're down about 23% on the S&P as of Friday, and about 35% on the NASDAQ. So we've been whacked pretty good. And, you know, most people are thinking, well, we got to be closer to the bottom. You know, I've got to take a nibble and what have you. And, you know, I know that I have a very public platform. And so along with that, you know, comes a responsibility. So I am very reticent sometimes to share some of the things that I've been thinking. But, you know, our members know that all last year, while we were making these new highs, I was sharing with them that this is likely to turn over and roll over in a very bad way. I started last February, not 6 months ago, but 18 months ago, telling our members to short Zoom when it was at $588, and now it went to 90. I told them to short Peloton at 170, and now it's 10. I told them to short QuantumScape at 140, and now it's 10. And also Beyond Meat at 200, and now it's about $25. So there has already been a crash in what I call the second tier of the NASDAQ. All these secondary stocks, not Apple, you know, not Google, you know, not Amazon, although those have now started to roll over too. But I started to see this brewing storm, this gathering storm. And to me, we built the biggest casino market, you know, I've ever seen. I didn't live through the Depression, although I may look like I did. But to my mind, we've reached levels of speculation that I have never seen, you know, with NFTs and Bitcoin and meme stocks and IPOs and these what are called SPAC companies. And Dwight, I've kind of lost the picture here. Is everything still okay on your end?
Yeah, everything's good. I'm still seeing the charts, and you're coming through clear.
Okay, yeah, because I'm not seeing my picture, which is probably just as well. But I just want to make sure everything's cool. So, you know, to my mind, I had a visceral feel. But again, the market takes a lot longer to go somewhere than you think. The markets can stay irrational a lot longer than you can stay solvent. But now the question is, where are we now? We've had this, you know, carnage, $15 trillion in equity wiped out. And you think, well, okay, now there's time for a reset. To my mind, we're just at the beginning, right? This is not something you're going to hear from too many people. And I don't want to be this Grinch. I am going to show you what I'm looking at. I'm going to show you how I interpret it. I'm going to show you how I trade it. And then you can make up your own minds. So again, I'm very reticent to share this, but to my mind, we are, you know, going to go into, you know, a big down swoon. And so I have been advising since February, since, you know, last November, I've been advising our members to get their, you know, major assets, get it out of the stock market, go into cash, get into a capital preservation mode, because this is going to get ugly. And I still believe that. So what I'm looking at is this, what I look at is a series of patterns and price action. And I'll go ahead and just put our strategy booklet in the chat box here. I'm just going to put that in there. And this little workbook has the chart patterns that I look at. You know, in a few days, I'll kind of give you my book, which also goes into this in a lot more detail. But basically, I just look at price action and price patterns to determine direction. So I don't really care what Jay Powell says tomorrow, or, you know, where interest rates are going to go, or if we're going to go into a recession. To me, I look at the market and then I look to make risk reward calculations based on what I'm seeing in the markets. So it all starts off with a premise where either, you know, when I'm looking at something, I say to myself, is the market going up? Is the market going down? Is the market going sideways? Or is the market turning from a down market to an up market, or from an up market to a down market? So these are the 5 phases or conditions of the market. And I will trade all of these conditions except this. So I'm looking to make money. I'm looking to make money when the market moves from one level to the other. I'm not looking to bang it out with my broker and try and get 7 pips here or 20 pips there or $3 out of a stock. I'm looking to take a piece of the middle out of major trends. So when the market is trending, I'm just looking to take a piece of the middle out of those trends. And so in order to do that, I look at time frames that give me a big picture, a global view. So this is a weekly chart of the S&P. And you'll notice this is what we call a clean or a naked chart, because you don't see any volume down here. You don't see any moving averages. You don't see any MACD. And you don't see any Bollinger Bands or any indicators of anything at all. This is what's just called a clean or a naked chart, where all I'm looking at is price and time. And I'm trying to determine, is the market trending, or is the market turning, or what is this market doing? And to my mind, this market is turning. It's turning from an up market to a down market. And the way I know it's turning is that there's always a pattern before that turn. And to my mind, we formed this double top. It's just what it sounds like. The market goes to a peak. Let me use a different color here. This is kind of a funky or asymmetric double top. So you go to a peak, you drop off, you retest that peak, and now you come through the neckline. And actually this double top neckline was about here. So now once you penetrate this neckline, it now confirms what you're looking at. It confirms this pattern. Sometimes there's all kinds of fake outs where we think we see a double top. You can see like right here, we had a double top, but it didn't confirm it. It never went through this neckline. You can see it just stopped short, gave you a little fake out, and then went on its merry way again. But this made a double top, and it did confirm by going through the neckline right here. So now we know that this reversal is in force and effect. Now it can do all kinds of things, after it's reversed. You can see that, so we have really 2 patterns here. So we have the double top. I don't know where I drew all my lines, so I got to get rid of all this stuff now. Just give me one moment and just let me clean this up a little bit. We have a double top, and to my mind, we also have what's called a head and shoulders. So you can see that we have this left shoulder, we have this peak, which is the head, and then we have this right shoulder. So it looks like a man or woman's head and shoulders. The difference is that this is a little bit downslope, meaning that the connecting line is, instead of being horizontal, we have the left shoulder a little bit above the right, and so we have this downsloping thing. So now either way you look at it, whether it's horizontal or downsloping, but the thing is, the implications of a downsloping neckline are such that this is going to be going down much more violently. That is the implication of this downsloping neckline. So now we have a combination of the intersection of 2 major reversal patterns, the double top and the head and shoulder. So I don't need to listen to Powell, tell me, about the future of interest rates and unemployment and, where the dot plot is and what the trajectory of interest rates are and whether we're going to have a recession or, we're not going to have a recession. My opinion is we're going to have a recession and it's going to be a lot worse than people think. But, if the market starts going like this, then it will tell me something else and I will be on the other side of it. So it's very, it's not constructive for people to have some kind of macro worldview of what's happening. And again, I don't want to overwhelm anybody. It's not like you need an economics degree from MIT to be able to figure this out. In fact, the less knowledge you have, the better off you're going to be in trading. You know, knowledge is actually counterproductive to trading. The more you intellectualize and overthink things, the thing is, I try and be objective and think about things dynamically. And so what I'm showing you is how I'm viewing just prices and price action. Why these things are doing these things are irrelevant. They're just telling me what this market is likely to do. Now, it's entirely possible that we bounced here. We can bounce back to this breakout line, go back to 3,900 on the S&P. So even though you're hearing me say I'm so bearish, I'm not discounting the fact for the next 3 weeks, we could be going higher. But the big picture here is that we're going much lower. And I think lower than people think by virtue of this very simple picture. So this is all I look at. But frankly, I think Powell told you in his press conference last week what is going to happen. He didn't say it. He couldn't come out and say, I'm going to put this thing into a recession. But he said 3 things. He said, I'm going to raise interest rates. Unemployment is going to go higher. And we're going to try and push inflation lower. So you've got higher interest rates. Excuse my writing. And again, this is really not helpful. It's not helpful to think like this. But we are going to have higher unemployment. So unemployment is very low right now. So, you know, it's right around 3%. Most people are fully employed. So Powell doesn't care if it goes to 5%. It's nothing. And he's going to try and lower inflation. Right? So what is the one scenario that can accomplish this basket of objectives? So we are going into a recession. I mean, it's kind of a moot point. We were down 1.4% last quarter. We'll know at the end of July if we were down this quarter, but maybe we had 0% growth. So maybe we'll miss, you know, we'll miss the official definition of recession, which is 2 quarters of negative growth. So maybe we'll miss it by a hair, and by a rounding error, you know, people say we're not in a recession. Well, we're going into one, and it's going to be really hard. And I think this market is going to get body slammed. And so my whole attitude is every time this thing rallies, I am shorting it. Every time this thing rallies, this is a bear market. This is what it's going to look like. It's, you know, and these rallies can be huge. So, you know, this is what it looks like. So I start off with a certain premise, and then I try and drill it down to an area where I can, you know, get a risk reward trade on. So what I mean by that is, you know, you can have all these fancy things, but trading always comes down to how much do I have to risk and what is my outcome? And I always try and find pockets where I can find a very small amount of risk for a much bigger outcome. And that's really what I'm trying to achieve. So right up here, when this rally topped out, and this is a weekly chart, I'll show you on the daily chart what it looks like. When it came up here again into the following week, I started putting on massive bets on this was going to decline. And I bought what I call put options, which is basically a leverage bet on the decline. And I started buying put options in the Dow, in the S&P, the Qs, and everything. And then this thing fell massively. So I made a lot of money on this move. But now, you know, you're in a what I call a random area where, you know, you really can't. So when I got short here, this was really the high. So, you know, let me just kind of, well, so when I got short right at this top, I felt like I had little or no risk. But now, you know, that it's fallen, it's much more random. You know, do you get short here? Do you get short here? Do you get short here? And this market can go all the way up there and I will still be right. But the point is that now you're in more of a no man's land where it's not as easy to quantify the risk and reward. I need more information from the market to set up another high value trade. And this is what I'm not trying to do. I'm not trying to be in and out all day long. I'm trying to find one area of the market where I can get on a trade, make a bet, and see a giant move. Now, it doesn't happen every day or every week, but I made 7 figures in that move. So I don't need, too many of these, in a year. So this is what I look for. I look to establish what is really going on. What is the central premise here? Once I understand what the game is, to me, this is just a fake out. So I always say, like, the market's like a magician, right? A magician never just comes on stage and pulls a rabbit out of the hat. He always kind of does a razzle dazzle with his right hand to get you distracted while he's doing that other thing. And that's much like what the market does. So my thing is that I always want to know, what is the controlling, trend or pattern? What is actually going to control this thing? So by understanding this, I will know what to do, this week, next month, whatever. Is that this is telling me that this is reverse. So on balance, this is going to be ratcheting lower. Now, there's going to be all kinds of times where it goes higher, and I might be on the long side, but I'll know that if I take a bet, on the long side, that I'm not going to overstay my welcome before this thing turns again. So I try and understand, the cards that I'm holding. And so I think this is the problem that most traders make, is that they're trading on short-term charts, 5-minute charts, 1-hour charts. And this is a weekly chart that gives me, 2 years or 3 years worth of data, that I can understand what the big picture is. And so I'm always looking for areas or pockets of risk and reward. So I'll show you what that looks like. So this was my account. So, I'll go long, I was long all these things. I was up like 40 grand on all of these things. And then I got right out, and then I got on the other side and I got short. So I made a whole bunch of money on the long side. This was just 2 weeks ago. And then I started opening these bets. This is 250 options on the triple Qs that had like 2 days to expire. And I put 50 grand into this thing. I bought them at 190 and I got out of them at 14. I made 700% of my money in 2 days. And you can see I was short 5 Below, Illumina, Restoration Hardware, and Tesla, all stocks that I've been telling our members are going to go down. And so, that's not a typo. I was up 390 grand in those options and 205 in those. And I was up collectively 613,000 on those bets. So, but today, not so good. These are my positions today. I'm down that much in Tesla today. So I'm short Tesla, and, right now it's going against me, but we'll see what happens. And I'm up this much in FX and gold positions. I'm long the euro yen, long dollar yen, short silver and gold. So the way I was able to make those big bets and those huge payoffs was, again, I understand the big picture, and then I look for areas where I can understand risk and reward. So what you're looking at here is a chart of the triple Qs. So the triple Qs are an ETF that basically mimics or mirrors the NASDAQ. So, Microsoft and Apple and all these stocks are in this NASDAQ composite, and it's it's called the triple Qs. So if I want to make a bet on the whole market, if I want to buy the NASDAQ, I'll buy calls on this. If I want to bet on a decline in the NASDAQ, I'll buy puts on this. So this, just like the S&P, is in what I think is in a global downtrend. The major pathway is lower, but that's not to say that these stocks can't have major rallies along the way. And some of these rallies are, they'll curl your teeth. This is what's called a short covering rally, where everybody gets short and then they raid the stops and it goes straight up. And so this is what you have to expect when you're short. And now that you're down here, very feasible that this thing has another rally, which would need to be shorted at some point. Now, how do we know when to short it? when it, when a rally ends, or, when a down move ends, or when an up movement. I simply look at the market. So you can see that this to me is the dominating pattern. So you can see that these double tops appear on all of these time frames. You have the head and shoulders and the double top. And so this tells me that this is the major pattern. But along the way, again, you're going to have up moves. And the question is, how do you kind of, get it in this thing? And so this is where I put on this major trade, where I just noticed that this rally made a new high there, and then it just started running out of steam. So whenever I notice something make a new low, like this did, then I say, well, what did it do the next day? What did it do? It didn't make a new low. It didn't make a new low. So it indicates that this is like an area where, it could turn. So this made a new high. And then the next day, it didn't make a new high, didn't make a new high, didn't make a new high, didn't make a new high. And this day was what I call a reversal. You can see that it made a high, but then it closed on the low of the day. Now, this is a daily bar. It's 1 24-hour bar. And so I look for patterns, and then I look for certain price action that points me in the direction of how I need to get into the trend. And I call these price action bars insurance day bars. Insurance day bar. Now, if you're on a weekly chart, it's an insurance week. And what is an insurance bar? The way I define it is, first off, one form is what I call a key reversal. And this is kind of what it sounds like, where the market goes in one direction, and then by the end of the day, it closes in the opposite direction. So first off, what you'll notice, this is a bar chart. Most people use candles. I use bars because, to me, how something closes relative to the high and low is very, very important. So everything during the day is random, but how it closes tells me a lot, gives me a lot of information. So you can see there was a bar. After this double top was formed, there was a bar right here. Here was a key reversal. This made a new high, but by the end of the day, it closed on the low. So when I see something like this, I can set up a trade and say, I can sell it here. I can put my risk somewhere above, unchanged, arbitrary. The best thing is to keep it out of the way. And then I was into that kind of trade. So just by observing the price action on that day, it told me that how to join this trade. Now, it was the same thing right here. This was a very subtle little reversal, but it was after 8 days where this thing just couldn't make a new high. So, it's like, you ever go to one of those airplane shows where you see like an airplane go straight up in the sky, and then you hear it sputtering there. It's like just runs out of, it just has no more energy, has no more gas to get any higher, and it just starts plummeting back to earth. This is what this felt like. This just felt like pushing on a string. This couldn't make any new highs. And so it was that airplane sputtering. But, if you're cognizant that this is a massive bear market, anytime this thing stalls out, you don't want to be on the other side of it. This gets up here and starts, stalling out. You don't want to be on the other side of it as it goes down that way. So this is what I'm always looking for, is that once you understand the game, then, this could keep rallying. It could do anything it wants in here. Like I said, it's very now random. So what I try and do is isolate areas where I can understand the risk. If I get short here, where's my risk? I don't know. Is it here? Is it here? Is it here? It's arbitrary. But by getting short right here, I know this is my risk right there. So I literally had this much risk for that much reward. So that, to me, is what trading is all about. We can talk about, technicals and double tops and Powell and all of this. Trading really comes down to a very simple equation. What's your risk and what's your reward? And if you can make a case that your risk is small and your commensurate outcome is much bigger, take that trade. It doesn't matter if you're right or wrong, because I'll make so much on this trade that I can lose the next 10 trades and still be a big winner. So I can lose 10 out of 11 trades and still be a big winner because I've taken out a massive amount on that. And that's what I'm looking for. So sometimes I'm probing the market. I'm trying to figure out if it's, you know, if it's feels good. And how do you know that? The market tells you. So when I get short here, and then the next day the market collapses, and then the next day gaps open, it kind of tells me I'm on the right track. So this is what I'm looking for in my trading, is to identify pockets of risk and reward. So the first definition of an insurance day bar is a key reversal, and the second is an inside bar. Again, it could be an inside week bar, an inside day bar, depending on your time frame. And what does an inside bar mean? It literally means where the range sits within the other. And I'm trying to find an example of that. So there is one all the way here, but it's pretty obstructed. So I'm gonna have to just get out of all this stuff. So here's where you see just, this is kind of a go to the bank kind of thing, where you see the pattern, the direction. And then once I understand the direction, this is a downtrend. Then I wait for the pattern. And then once I see the pattern, then I wait for a bar that tells me where and how to get in this thing. So you can see right here is a little inside bar. You can see the high and low of that day literally sits within the high and low of the previous day. So what this bar tells me is that this is a coil. This is a storing of energy, right? So this thing is going down, and it kind of just stopped here to collect itself to build more energy, so then it could just really go down. And you see another kind of inside bar like right here. That bar and that bar is inside there. So all you have to do is put a sell stop under here, and now you're into this. So what these inside bars tell me is that these things are just storing and coiling energy and are going to break out in the direction as indicated by the pattern or the trend. And these really were a collection of like inside bars. There was like 8 days, kind of one inside the other. So to me, this represented a giant coiling and storing of energy. And the more it coiled, the bigger the outcome. And that's exactly what happened. I bought Dow Jones puts for $1.40, and 2 days later, they were worth 14. I made 10x or 1,000% in 10 days in 2 days on this move. And that's the power and the magnitude of kind of understanding, just very simple analysis. I feel like I could explain this to a 6-year-old. So you don't have to have any special skills, come from any special educational background. I look at price, I look at patterns, direction, and price action to set up monster moves in the market. So Jay says, does Mark use day session? Yes, so this is a daily bar, right? Where each one of these price bars represents one 24-hour session. And I wait until, I see how it closes, and either I will, short it on the close, because I'll feel like, okay, this closed low and it's going to open lower, or I'll wait the next day, kind of either short into that or short into a new low. But I will use, a collection of all of this information to set up a risk reward thing. So I might just get an initial position on in the morning, in the afternoon when it closes. And then if I feel like I'm on the right thing, I'll add to my position, and, I'll do different things. But the whole premise is that I'm looking at, a relatively long time frame that gives me enough information. Because really, again, my objective is to take a piece of the middle out, right? And so I'm not looking to, just get in and out of, some of these little things, 10 times a day. I'm looking like a straight flush, or I can, make 10x on my trades in that kind of move. So it doesn't happen every day. And now, but the point is, what I'm trying to really make here is that there are certain times where the market, there's almost like no risk. If I short here, that's my risk. And so I can see or understand my risk. Now, if I get in here, if I get in long or if I get in short, I really don't know where my risk reward is. So there are certain times where the market becomes much more random. People are looking at me for answers. I'm telling you, this thing is going to go down. I just don't know if it's going to be 3 days from now, 3 weeks from now, but it's going back down. People say, well, have we made the lows? And I would definitively say no, but can you see this over the next 3 weeks? It's entirely possible. So sometimes the markets just become somewhat a little bit more random. But, again, I look for a collection of bars where it makes more sense. So one of the things that I'm short is Moderna. And Moderna had what I call a key reversal bar today, a key reversal. Now, one bar doesn't. So this is Moderna, right? This is a long-term chart, the medicine maker. I don't care what it does. I don't care if it's going to invent, a way to cure cancer. If it did, the price would tell me something different than what so to me, the market is a discounting mechanism. The market is ahead of events. You hear all the time that Powell, the US Federal Reserve, he always says, I'm data dependent. I'm going to wait until we see the data, in the next, meeting to see if we're going to raise interest rates or not. And to me, this is crazy. And this is why he's been so backwards and he's misread this thing so badly, because by the time the data comes, it's too late. The market is the market is ahead of the truth. The market is discounting mechanism. So, we were in the midst of COVID, when this was a very valuable drug, and yet we had some very bearish price action in Moderna. So it all started off with this governing or dictating pattern. So this pattern here tells me what to do here, 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 and here. Sell it. When these rallies get exhausted, just sell them, because this thing is in a downtrend. And now you're just basically in another bear pattern along here. And I shouldn't be so arrogant or definitive, because sometimes the market will jump out of something that I anticipate. And by virtue of it not doing what I expect to do, I'll do the other thing and I'll make money the other way. So I don't really care. I don't take an opinion. If this thing starts coming out of here and start doing something that I'm not anticipating, I'm not going to say, well, I'm right and the market's wrong. My premise is the market is always right. So if it started doing this thing, I would buy it just because it's not doing this. So my expectation is that this should eventually go that way. So we're trading about $130 in Moderna. I think this is a $80 stock, $70 stock. I think this thing gets cut in half. So so I'm just looking at this pattern. I'm looking at the basic trend is lower. I'm looking at this pattern right here. So you see, so sometimes there's intermediate patterns. So now I don't think it's going to get over that. Now you had another double top right here. So you have all these patterns. And so, is it possible that, Moderna bangs to 150 again? It could, but I'm not really betting on it. I think it's going to peter out pretty soon. So, now, once I kind of feel like I understand the direction, I understand the patterns, then I wait for my insurance bar. And this is basically what we have. You made a new high today and you close on the low. Now, that in and of itself, you may need another one, but let me blow it up a little bit more so we can see it like this. So now I can start seeing an area, a pocket, where I can make a risk reward determination. So if I think this is going to, $70, the question is, what do I have to risk in order to, make that play? So when I look at this thing on a closer thing and I understand all the prior history, I see the double top here. So that tells me, sitting on top of this recent price action, very unlikely we're going to see it go through that ever. I shouldn't use the word ever, but I'm going to. I don't think you'll ever see that price. Not for a long time. So then you're in this downtrend, and now you've kind of got this other kind of top right here. And now we're just banging. It's somewhat random. You know, this is an area where it could just bang and bang, and it's still a bit random. But what I try and do is, you know, look for clues on how to get on the right side. And so I look at today, and even though we did close higher, you can see we did close like $1.50 higher. I actually just shorted more into the rally today. I just don't believe that it can sustain. I don't care where it goes. I'm just going to keep selling it. So this, while it did close higher, it closed right on the low of the day. So what this says to me is we went higher, but by the end of the day, the sellers were in control. And maybe this isn't a full-fledged thing. Maybe we need, so I don't really see prices kind of cutting through this thing. So maybe we need a few more bars in here, but this is starting to tell me that this is an area where I can start understanding risk and reward. Maybe you need another day where you get something like this. And, you need a few days to build sideways like those triple Qs before it goes. But it's starting to tell me that, the 135 area where it got rejected today is an area where, I can start looking at where my potential risk on this trade is if I want to take this thing lower. So this is what I do. I look for the market for information to put me in a trade and to take me out of a trade. On the FX side, I've been telling our members that, we're in for a once in a lifetime move in the euro yen and the dollar yen. I told people at, 125 in dollar yen, and now we're at 28-year highs in dollar yen. So this is a monthly chart of the euro, right? So instead of using a 15-minute chart that gives us an insight into the last 5 days, this is a chart that goes all the way back to 2008. So this is 15 years worth of information. And so this tells me a picture, a big story. So the yen started, departing from 28-year norms here. It started breaking out of these key areas. So you can see if I draw a thing over the highs and draw a line, you have this perfectly formed symmetrical triangle. And for many years, it was banging lower within this thing, lower highs, lower lows, and the cadence was lower. But then all of a sudden it changed its cadence, and again, if you're looking on a huge macro 15-year thing, once it breaks out, I've learned if people say something, you should learn to listen to them. And if charts tell you something, you should learn to listen to them. So this was this key reversal, right? So we have this pattern, and I was kind of, I didn't know if this thing was going to break to the downside or break to the upside. So when you're uncertain, as there was a lot of uncertainty here. This was weeks, this was, like 10, 12 weeks, 3 months of just banging in this range. And I could have made a case that it's going to turn down here, or I was watching it to break out. And so sometimes we just have to let more history go by so we get more information so we can make a more informed decision. And this is, both a reversal and a breakout. And then a few weeks ago, you had another reversal and a breakout. And now you're at, you're close to all-time highs in the euro. So I think this thing gets to 150, no sweat. And so this is what I look at. I look at trends, patterns, price action to make calls on really big moves. And it's not like I have any special genius or insight or special knowledge, of what the Fed's going to do. I just look at everything. So I'm trying to find, this is the email that I sent out yesterday. So here's my video report. There was chart of the wealth destruction. This was a chart of what I call, velocity turnover. This is the amount money turns over. And since velocity is going down, it means the economy's slowing. This was the chart the Fed should have been reading. You see this long-term breakout of CPI. Instead of waiting for the data and watching it blow up in their face, you should have been ahead of it. So the Fed really needs a chart reader because the charts are ahead of the information. This is the round trip in Disney that I was talking about. So you can see Disney's currently trading where it was in 2014. So kind of buy and hold is kind of a canard. And so this was, my advice to our members: just buy this anywhere. Just put a buy stop at 142.01 and then buy it on breaks, and it never broke. It just, it just went higher. And so now you'd be in this move at 142. And now it's trading at 143.96, up 200 pips off that call just yesterday. So our members would be up 200 pips on that trade. And then this was a call, despite the up move in the market today, I said sell BNTX anywhere at 125. It actually went to 127 today and closed at 122. And I'm already short this stock at 149. So this is what I do, and I'll take any questions on the trading methodology. I know people are going to ask me to look at 100 different charts, but really what I'm trying to do is in these few days together is demonstrate a methodology, a way of viewing the markets through a prism that is completely objective, where you don't have to worry about what the guy on TV is saying, what the analyst is saying, what the Fed's going to say tomorrow. This market is telling you where it wants to go, irrespective of that information. So are there any questions? So would this process be okay using a 4-hour structure just for a smaller gain? So it's funny how I always say I use monthly, daily, weekly, and then somebody says, can I do this on the hour or 4-hour? And the answer is you can. Of course you can. But what I'm trying to do is see the forest for the trees. The more you start reducing the time frame, the more you reduce, your, analysis horizon. So, this is Tesla on a big thing. And then obviously I can drill it down to 60 minutes and look at it this way. And, if I look at it this, I could see, a double bottom here. I could see a double top here, and I can't see the forest for the trees. So yes, will you see patterns like this, on a 4-hour chart? The answer is yes, but, if you give me this hourly, so this is an hourly chart of Tesla, right? And what does this show me? Well, here it shows me that this is a double top. And here it shows me that this is a double bottom. So which am I to believe? I don't know. But based on what I analyze on the big picture, I think we're still going that way. But on this chart, it looks like you could be going that way. So, and you could be. I mean, you could still open up tomorrow and the short-term trend could still be higher. So it just doesn't give me enough information. So what you could do, what I do is that I start off with a premise where I say, okay, this thing's broken out. Then I kind of reduce it down to a daily thing where I can kind of see, some kind of smaller risk reward, offset. And so, once you kind of understand it, then maybe you can reduce it to a smaller thing. But, I try and, show these bigger time frames only because on the lower time frames, first off, it's much more ambiguous. Secondly, it encourages you to trade more, right? So you see more things, and I'm like that too. I have to force myself not to kind of dig in and look at a 5-minute and what have you. And I still find myself doing that. And all that says to me is that I'm insecure, that I'm really not confident of what, I'm holding and where it's going to go. But it also, what I'll do is I'll start seeing all these things and start over trading. And then that pattern of over trading becomes something that, becomes like a force unto itself. And how many of you people have been in trades where now it becomes a revenge trade and now you want to get it back? And now it's a cyclone where you just feel like you're in this constant motion and you almost can't get out of that motion. So what I try and encourage is a stillness, a quietness of the mind, a way to stand back and objectively look at something and, take out a big piece of the market, right? So these are huge moves in here. This is huge moves that, if you're looking on a 5-minute chart, you're going to be in and out of this thing 10 times a day. And all that's going to happen is the broker is going to end up with your money in their pocket. So, I try and find ways to quiet because there's so much chaos now. There's so many countervailing things. You've got Ukraine, oil, inflation, all the repercussions. And then you say, okay, we've got all this disaster. But then the other thing is, has the market discounted that? The market has come off 35%. So maybe you see all that carnage, but the market has now done enough destruction where it's again ahead of it. So it's impossible to, think clearly and act properly if you're in this constant cyclone. And, the problem is that sometimes the market does get into these things where it is, less definitive. But then we just have to wait for, it to sort itself out. This is what I say right now. This is, so the market made its move. And so the question was, what was it going to do here, in here and here? It's like kind of the stock market now. It's like it's made its move. And, now it gets into a bit of a random area where we really can't tell what's going on. And then we wait for the market to then break out and give us the clue of, what it wants to do. So look, I don't claim to have, all of the answers, and there's certainly not one way to do anything. I have just honed this approach over decades, making all of the mistakes. Believe me, I've blown out accounts and made all the mistakes. And then if I whittle it down and say, okay, what do I need to do in order to be a more consistent winner and really win big in the markets? And that really comes down to it. What are you here for? And most people say, well, of course I'm here to make money, but is that really the case? If I took away this thing and said, you could only trade once a week, you'd go into withdrawals. All of us are trading addicts. We're junkies. And so we want to trade more. We want that 4 hour, then we want the 1 hour. We want to see more opportunities. But the thing is, when you step back and see this thing going from 131 to 143, and you could have made $12,000 for every $1,000 you bet on one trade versus being in and out 400 times a day and ending up with nothing. So that's really the offset, and only, each of you can answer that question. So this is the euro versus the Japanese yen. Zad, or T. Washington. Ziad says, how do we translate your methodology to option trading, meaning specifically the expiration and strike? So that is a good question, Ziad. And I will tell you right up front, I am not an expert in options. I don't look at the Greeks. I don't look at the delta and the theta and the volatility. What I do is I look at the underlying. So if I make an assumption about what the underlying instrument's going to do, then I will just buy a put or a call to reflect that. So I remember when this was like at, where was it? This was like 307 here. And it was expiring in 2 days. So I didn't want to go too far out of the money. So I just picked an arbitrary put option. I think these were the 305s. And I paid $2 for them, or $1.90. And they went from 305 to 270. And went, whatever that is, 30 points. So I took out, it went from here to here in a Friday. So it went to about 280. So it went 25 things. And I think I took out, this thing went from 2 to 15. So I didn't, I didn't have any special knowledge of options. I picked a pretty arbitrary, sometimes like if it's on a Monday and I have till Friday and I feel like it's going to be vol. So first off, the thing about options is that you need to be right, and you need to be right now. So the thing is, I have a certain view on the triple Qs, but it could go here and whittle away. And if an option doesn't go in your direction, you just exhaust your premium very quickly. So you have to figure out that there's a coil, there's an energy here, and that this was going to unleash and produce some kind of flow through, some kind of energy. And so that's what you want on options. For it just to sit in a certain area is death for an option. You want to look at it in areas where now this has been going up, you see this thing and it's going to turn the other way. That's how you catch it. So now if I, was at the beginning of the week and it was Monday and I had the whole week and I saw a powerful move, I might, because the more out of the money you are, the cheaper it is. So sometimes I'll just pick some arbitrary thing way out of the money, even if I don't think it's going to get there and the move's powerful enough, those options will move. So I can't claim to have any sign. I just tell you that in order to make a bet on an option, you really have to understand the underlying. And you have to understand that the underlying is going to produce a move and it's going to be powerful enough to go through your strike price wherever you put it. And you have to calculate the premium. So sometimes in this market, because of the volatility, the premiums are so expensive. So, if I, sometimes on, some, things where the Qs have been, 300 and I'm looking at the 290s, the 290s could be priced at 8. So now I need an 18-point move just to break even. And so there are certain things that, I won't do just because the premium is too expensive. So I go in with any option bet that I need to make 3-to-1 on that thing, because I will lose a whole bunch of times. I'll lose 50% or 100% on certain bets. I've got some bets on silver this week, and I need silver to really move, or I'm going to lose all of my bet. So at some point tomorrow or Thursday, I need to figure out, do I need to just, I'm always looking for 3x on my option. So if I'm looking to, get into an option for 2, I need to see this thing go into 6. So the underlying needs to go to a value by that time frame that will meet that objective. And, so I just make all of my option determinations based on what I'm looking at on the instrument I'm looking at. So I need to understand where it is and where it's likely to go and produce, a certain powerful enough energy. And so in here, this is not where you want to buy options, where it's really ambivalent and it's just going to bang. So this is, there are certain times to do it and certain times to not. And I loaded up the boat here, made this flush, and now I'll just wait for the next opportunity. And once it come back up here again, I'll just bang it again. So in fact, there may be a trend line here that we can look at. So I'll just, wait until I see the market come back into certain areas. So this could very easily, come back into here, come back to 300, give me a look, and then I'll get back on the train again and start pounding this thing. But I start off with a certain premise. This is a bear market, and any rally we get is a bear market rally. And they're very, they don't stop, right? So bear market rally, it doesn't let you out. It doesn't let you out. It's one of the worst things to be caught in. If you get short here and you have to sit through this, you get wiped out. So it's not as easy as it sounds. Just because something is, these short covering rallies are blistering. They can come out of the chute just with enormous energy, and they look so real that it's hypnotizing, right? And we're all conditioned that this market always goes higher. But this is what's going to happen this time. I think it's going to go a lot lower than people think. So Molly says, can you explain how to do a buy stop or a sell stop? So I'm not going to go into great detail. You can, basically YouTube all these things. But basically what I do is I always look to confirm my trade. So Moderna closed on the low like this, had this key reversal. So what I, advise our members to do is put a sell stop just under today's low. So today's low was Moderna was 129.67, and we closed right there. So I would just, put it, a hair under here, put it at 129. That means if it opens tomorrow, it'll open, so, just put a sell stop here at 129. So a stop order is a resting order, right? So tomorrow, if Moderna opens and just goes higher, then I won't be triggered. So I always look for the market to confirm my order. And what I always prefer in something like this is that I don't want to get triggered right on the opening, right? So when it closes really close to the low, you really shouldn't put your order in right away. I don't like it opening here, going lower, and then starting to come through. And once it starts coming through the yesterday's thing, then it can go the other way. So really what I would prefer is that I look at see how the energy comes in during the day. If the energy starts lower, then I don't really like that. If it starts higher and then starts drifting down and then hits me, then I feel like I'm on the right track. And the buy stop is the same thing. If you want to buy something and it closes well, I look for a confirmation, and I would just say put a resting order, above that, outside of that high. And if the market, doesn't confirm it, then no harm, no foul. I love having these, sell stop orders in, and, I'm wrong, but I don't get hurt. So I just use it as a way to confirm what I'm looking at. After you read his link, let's see, can you go through Tesla? I'll go through Tesla and then we'll end it there. I'm just going to see. Daniel says, I lost big on silver using a daily. I suspect my mistake was when switching from a lower time to daily week. I need to make small. So silver is one of these things. Again, I said, I trade all conditions except a sideways condition. And the problem is for silver has been in a sideways condition for years. And so, it's really a haphazard thing, kind of handicapping it. But my thinking is it's gone sideways for so long that by and large, it's going to make a move. And to me, you can see that we've been trading right on this 21 low for years now. But to me, the larger patterns tell me that this is a distribution, meaning that it's largely selling here. This whole thing is selling. And when this area does get taken out, I think that it will go lower. But here's the thing. If it doesn't and starts going the other way, I'll do that too. So sometimes I will look at a chart set up with a central thesis and assumption. And guess what? If the market doesn't, go according to what I'm thinking, if my thinking is this should go down. And if it doesn't go down, it's going to go up. And it's really that simple. Sometimes it's just really being stupid. You got to just leave your mind out of these things and just see what the market is telling you. It's giving you information every day. So this is a weekly chart. And so, this tells me that, I see this very bearish pattern here after all this bearish stuff here. So I think that ultimately this thing's going to break to the downside. The problem is it just keeps holding in here. I bought these put options that expired this week. So I need this thing to go through 1950 on SLV. I bet on this ETF. So you can see that we've kind of got this bit of this rounding top in here. And so it either needs to contain in here and start doing that. And if it starts breaking out of this little coil, I don't know that I go long, but I would be on alert. So I always, again, I put my boundaries, to me, you read a textbook and you see a double top, and then, in the textbook, it looks like that, but the markets don't work like that. The markets are dynamic. So it's taken me a long time to figure this out. So, I'm very good technician. I understand these patterns very well. But then I look at how does the market respond to this pattern? So here we're looking at a double top head and shoulders. And so my thesis is this is a bear pattern. And that if this pattern is correct, this is what we should see out of it. And if we don't, and it starts breaking that pattern, it's called a busted pattern, where it starts busting the implications. But I at least start with a premise where this is what I'm looking at. This is what to me is governing the market. and I'm positioned accordingly. And if, it doesn't cooperate, then I'm going to get out, and I may just go the other way. Although, this could, still come up here and still be a declining, wedge triangle. So I think this is on balance a bearish market, but it's just, hanging around this, area. But the more it hangs around, I think the more chance that it's going to, one day you're going to wake up, it's going to be there. Hopefully it's this week, because I've got a huge bet on that happening. So we'll see what happens. So Jay says you have to have elastic thought. So yes, you have to think dynamically, but to me, it's within a certain structure. So, elastic means that you could also be swayed all over the place. So what I do is I set up with a premise where I say this is a head and shoulders pattern, and then I see how does the market respond within that analysis. How does the market, so this is my double top, this is my head and shoulders, this is kind of my neckline, which is simply a line throughout the pattern. And you can see we kind of broke out, and then it's a bit of a bear trap. Anybody who chased that now is trapped, and, it could go the other way. But, I think that, it could do this throughout the summer, just go, sideways, but eventually I think you're going there at least. So again, the market does everything in its own time, but I have a certain thesis and a prism with which I look through at the market and then look for opportunities. And so to that person who asked me about puts and calls, what I'll do is I'll buy puts into a market rally. So if this thing starts rallying to 3,900, we're at 3674 in the S&P. If we start going to 3,900, I'm going to start buying puts into that rally in the expectation that it's going to roll. The problem is, if you don't have the right time frame, it could go to 39 and then just go sideways. And then your option premium just gets busted, but you may be eventually right about it. So it's all about getting all of the things right. So options are very dangerous, but you can also make a lot of money. So it's a two-way street there. Alan says, do you use trailing stops? Yes, sometimes. You show many examples of a reversal. Can you show example of trend trades? Well, so this is a trend trade. I mean, the S&P was a trend trade, right? So like I said, there are certain bars like the euro yen that are more important than others that stand out. This is why I look at bar charts. So this made an all-time new low, March 23rd, my birthday of 2020 in the height of COVID, and then made a new high and this is a weekly chart, right? So that sometimes the market just puts a stake in the ground and says, that's it. I'm not going any lower. So, when you see these things visually, you say, well, okay, if I short this, can I see prices going through all of this? And so to me, there's also a visual kind of interpretation. So now once this thing starts to lift off, maybe you don't know that this is a trend, but now it starts breaking out to new highs, and now it's a trend. So now all you want to do is just surrender to the will. And so this is what I'm looking for. I'm either looking to make a bet this way, or if it's going that way, I'm looking to make a bet that way. If it's turning, and then if it goes down, makes a bottom and goes that way, then I'm going to buy here. So this is what I'm looking for. What I don't want to do is get caught up into, one of these things where it goes very quiet and you chew up all of your time and money. So I'm looking for markets that are thrusting, whether it be gold or crude oil or the euro yen. There's always something that is moving from one level to the other. I don't want to sit in something like this. That's what most traders do. They look at a 15-minute thing, they figure a range, and then they're just going to bang 50 pips out, every time it goes up and down. That's just not my thing. If that's your thing, that's not what you're going to get here. I'm looking for big whacks out in the market. This gives you an example. I'll just take you through a couple of trades. So here's where I told our subscribers to start buying the yen. This was March 13th. This is when the dollar yen was 117, and today it's 137. It's a $2,000, $20,000 move for every $1,000 you bet. So that's what I'm looking at. Breakouts of long-term symmetrical things. I also, bought the euro yen, and I made a packet of dough on that move. So that's what I'm looking for in the markets. Here's a gold trade where I, said sell gold at 1919, sell it at 1827, and that's where I got out. So this is what I look for in the market. Here's a pound New Zealand trade. I said buy it here, add to your trade. It was up 900 pips. So not only was I not getting out, I was saying add to your trade on here. I said I'm currently long at 192.77, and it was trading at 199.61, and I got out. And so this is what I look for on my trades, that kind of stuff. And says, how can I start with a small account of £1,000? It's, you can start anywhere. It's all about risk management. And, people think that in order to take out the big moves, they have to have a big account. And it couldn't be further from the truth, because if you think about it, a 1% move on a $500 account is the same as a 1% move on a $5,000 account, is the same as a 1% on a $50,000 account, and it's the same as a 1% move on a $500,000. It's a 1% move. So people think, well, I can't follow your strategy because I can't have it, I don't have a big enough account. I'll talk about that tomorrow on how to position size. But all it means, Ant, is that you have to take a much smaller position, but for a much bigger ride. So if you can take that 1,000 to 1,200, by being long the euro yen for 400 pips on a very, very small thing, that's how to build your account. Not trying to be in and out, 10 times a day, trying to carve out 4 pips here and 7 pips there. It's just never going to happen. Alan, there are all kinds of strategies, and what I try and demonstrate is I try and understand what is this market telling me, and then there's all kinds of ways to set up different things based on. First, you have to understand what's going on. Most people don't understand what's going on, and when they look at things through a prism of a 60-minute chart, like Tesla, it's banging all ways, and you can't see the forest for the trees. So the first thing is to understand the cards you're holding. That's why I peel out to a bigger time frame, because if I'm just looking at this part of the chart, I can't really understand what's going on. I have to understand where it comes from and then where it may be going. And I don't think that's going to be a overstatement, by the way. I'm freaking bearish. And, there's nobody on there talking, to the extent that I feel like this thing's going to come off. I think this market is broken. But I try and, holster my emotions because I don't want to get people all worked up. Yeah, good question from him. Could you cheat mark in the trillings? So I'm going to basically end it there. This was just an overview and an introduction. Bruce says, do you think Tesla is still ready for a 100-point move? Not quite sure what that means. Tesla is going to go lower. I have a huge bet. I'm losing a lot of money on that bet right now. I might be wrong in this time frame. That's the problem with markets. I think I've got the idea right, but this thing got to a certain area. This is Tesla. It's here. I mean, it could bounce all over this place. It could go straight up and still be in a bear market. But what I'm looking at on the bigger picture is this huge. You have a double top here, and you have another double top there. So you have a collection on the daily and weekly, all of these tops, which tells me the market has topped out. And if the market's topped out, on balance, it's going to go lower. But here's the trick. The markets get into these areas where, there's some price history. And so they just oscillate around these areas. They bang, so here it went to 600, back up to 800, back down to 600, back to 750, and on it goes. So I think that, it should, on balance, have lower highs and lower lows. And I think that I don't think these highs should be taken out. So these two key reversals here, right around this 780 area, that I don't think will get taken out. So I do think that this is the biggest bubble market we're looking at, and people are infatuated because, Elon Musk is a genius, and he is, but it doesn't change the picture. To me, I'm just looking at the picture. I'm not getting, carried away with the charisma of a cult-like leader. I'm just looking at a picture. And now I'm looking at, what does this picture do? So does it hold here and keep doing this? And if it busts what I'm thinking it's going to do, at some point I'll be on the other side of this trade. But right now, this is my guiding picture, that I think it's going to, go much lower. In fact, I think we're just starting, right? So we've just come through the neckline. So any penetration below this price here would actually confirm what I'm looking at. So it really needs to go to 600. And then when it goes to 600, it's going to be good for 200. So I think this is the biggest bubble market that is just waiting to go pop. Bruce says, how can I get a copy of this webinar? I'll put our support team link, support@thepatterntrader.com. So just send a message there, Bruce, and they will send you a replay. Jane, you're welcome. Alex says, so you don't buy 6-month options to ride more of the move. So you could. And I've started buying some out of the money put options in Tesla about 2 weeks from now. I forgot what I did today. It was just 2 weeks, but the more you go out, the more expensive it is. So I did take a look at this, and I think you could. Let's say you go to Tesla, go to the options. So we are in, what are we in? June, late June. So let's say you want to go till, you want to do 6 months. So here's the problem. You want to say, let's say you want to do a 550 strike price, which is, $200 lower than where we are now. If you go to 550, those puts are $63. So that's the problem. And you have to multiply that times 100. So that means you have to spend $6,500 for a put option 6 months from now. So then you have to minus that premium that you paid off that strike price, which puts your break even at 485. And then I say, okay, I need to make 3 times that. So 3 times 65 is $195. So in order for this to be worth $195, Tesla has to be worth $350 by December. Now, I think there's a good chance it could be. And that way you would get paid 3 times. But this is just too much premium. When I look to get 3 times, I pay $1 or $2. If I'm wrong on this, I'm going to lose $65. So that's kind of the problem. You have to play around with, what are your expectations? What is realistic? What do I have to risk? And all of that. Now you can do straddles, you can sell calls, you can sell all kinds of stuff. You can sell puts out of the money and reduce that cost. But that's the idea. The further out you go, the more expensive it is. So even though I think Tesla's going to $350, if it goes there by January instead of December, and I paid all this money. So it's always this jostling. And I'm always looking for these little things where I can, buy it for $1 and, sell it for 3 or 5 or 14. Once you start buying something for $65, that's a heavy risk. So I always look for things like SPXU. This is an inverse. I made a ton of money buying the calls on this. So this will go higher if the S&P goes lower. And so, the option premiums in that are not too bad. So I'm always looking for little markets where I can take 1 to 3. And actually the credit markets are great to do that. So this is the inverse. So when this goes up, the S&P is going down. So you can see this has been going up, which means the S&P is going down. So, I kind of will look at this to see when this stops going down, and then I'll buy call options on this to bet on the S&P going down. But, and I'll leave you with this, and maybe, I don't know if I should do this. I don't want to overcomplicate it, but I look at the bond markets as well as the stock markets, because in order for the stock market to go up, you need, the bond market to start stabilizing. I showed you all of the losses that we've accumulated, the wealth destruction, and it's primarily been in the bonds. So this is the 20-year treasury bond, right? So I buy puts and calls on this also. I mean, the moves are much easier to see on this. So you can see this is going in the wrong direction. This is an inverse thing. The more the price goes down, more interest rates are going up. So I'll look at TLT and I'll look at HYG. This is the high yield corporate bond debt. And this is the picture that you don't want to see if you're bullish stocks. You can see how this is deteriorating. And this means that there will be a lot of defaults and bankruptcies and a lot of, all bear markets always start with a panic and a credit crisis. Nothing like a good credit crisis to start your day. But this is what we're looking at. This is where all of the losses have come. So you can see bonds really should behave like this. When they start going like this, there's a problem. And you can see how steep this curve is. So this is an inverse thing. This is corporate interest rates. The price is going down, which means the interest rates to corporations are going up. So now a corporation that funded their debt at 3% now has to go and fund it at 8% when all of their customers are leaving them and the economy is going into the shitter. So there's a problem here. And you can see that there is no bottom. This thing just looks like, and then this is where the problem is. It's the stock market is one thing, but it's the credit markets that once these things become untethered, which they become, you can see this is starting to look ugly. And this is where the problem is. That's why you cannot be long stocks. You can go on a ride, you can cruise, on a ride for a few days on them, but I'm talking about your mutual funds and your stock portfolios and whatever. Be careful. So Jackie says, so does Mark email positions when he thinks could be winners, or does he trade? So no, I send an email out at the end of the day. We have something called the Elite program, where once a day I will, at the end of the day. So what I want to do is I want to wait until I see something close to, understand what the risk reward is. And so today, I'm looking at like BABA. I'm actually thinking these Chinese stocks, could have bottomed. So you can see this is BABA. It has an inside day. So to me, there's a very small risk reward. If you buy it on the high today and put your stop loss under yesterday's low, sometimes I'll just create, different risk reward offsets. So I think the Chinese stocks are actually bottoming ahead of the American stocks. So like Baidu actually closed on the high of the day. And so I think that these Chinese stocks actually are bottoming and that you can actually buy some of these. But I'm not a fan of buying anything. I think we're going to go into a garden vanilla crash here. And so I'd rather be selling something. So I'd rather start selling, Moderna. So our members are short Restoration Hardware. They're short BioNTech. So this is Restoration Hardware. So this is a trade that I would do. You can see that Restoration Hardware is going lower. And today we had, not really a good enough reversal. So this is in a downtrend. And so we closed right on the low of the day in an established downtrend in Restoration Hardware. So you could start setting up trades here and probing the market with a small trade, put a pending order to sell it underneath today's low, put a sell stop here and create a risk reward offset, because this thing is going to go a lot lower. It's just the question of, does it move in here first before it goes lower? But this is going a lot lower. This is going to get cut in half from here. It's at 245. I was saying that up at 300, and we're already making our way down. So, I just look at all of these trades and, try and select a good risk reward trade. Our members have been, short since 149 on BNTX. Last night I said just get short again, and you would have got short at 127 today because the market opened around 130 and finished at 123. So this is BNTX, and now it's closing right at resistance. So, I put in a signal up here. I think it was on a weekly. Yeah, it was on the weekly. So the original signal on BNTX is right there at 149. So if you've been getting our emails, you would have been short at 149, and it's now at 123. And I would not get out of this. This is going to get cut in half from here. So this is what we do at the Pattern Trader. Ian says, thanks, Mark. You've gone over loads of different markets. Could you talk about what you decide to look at? That's a really good question, Ian. And, that's the problem. When I was just an FX trader, I just had like 10 pairs I would, look at, 10, 12 pairs. Now with some of the yen crosses, maybe more, but there were like 15 markets, and I could, make, a move, a decision at the end of the day, what to do in things. With stocks, you literally have a universe of 10,000 stocks. So, I'm usually following just, 50 of them at any one time. There's only so much you can think. And I'm looking at gold. I'm always kind of, looking at different asset classes. I short some gold today. I shorted silver today. This is an example of a narrow range bar day. So this is gold. And with just this history, I can make this assessment. This looks like a double top trading pattern. So that to me is a reversal, means that this thing is going to go lower. So my whole context now, whatever this thing is doing, it's ultimately going to go lower. So now once I view it things, so now, you can see that we kind of had this triple top here. And now we've got 3 inside bar days. All 3 of the last 3 days, each of these bars has sat inside the range of the previous day. So you can see they all sit within this range right here. So what this is telling me is that this is just building energy. This is just coiling. It's quiet. It's not doing anything. But to me, this is going to uncoil or uncork in the direction as indicated by the pattern and the trend. So you can see it's not doing anything. It's just laying in the reeds. It's sleeping. But to me, it's just building energy, building energy, building energy. Just like that triple Q trade that went straight for 8 days this way, and then it unloaded. So tomorrow we have testimony by Jay Powell on, whatever. And whatever he says is going to be very impactful on the markets. So I would not be surprised to see gold look like this tomorrow. And when you see it and it just comes out of the blue, you'll see the commentation, well, gold went down because Powell said this. No, gold went down because it told us all the way here. Price is a forward-looking mechanism. All the way here, these players were making determinations of what's going on in inflation, the economy, Ukraine, all of this stuff. And then the verdict comes out here and you go, well, how did that happen? Well, it was decided all the way there, and actually by virtue of a lot more stuff. So it's really, to me, just that simple. I just look at, price action, and this thing is coiling. So, the way to play this is, we still don't know. It could still go that way. It could do anything, is, put a sell stop, put a pending order somewhere underneath all of these prices. Either you could be aggressive, put it under this, today's low, or you could put it, under here. And, if it goes here and then up there, you're not put into a bad trade. So you could always just be laying in the reeds there, leave that pending order in, and if it clicks you, there's a pretty good chance you're going to be in a good trade. Thanks, Natalia. Thanks. Natalia's a great member, always supportive. So thanks very much. So I'm going to leave it there. Wow, I'm already an hour and a half into this. I could talk forever on these things. So I just wanted to communicate a way of, filtering a lot of stuff into a very simple risk reward setup. So, again, this is what I look for. If I can put a sell stop here and a stop loss there, this is my risk, and I could be in $1,000, win, from this. I could risk $10 to make 200. And that's what you have to do, is wait for little balls of energy to coil and catch it when it uncorks. And that's all trading is, risk and reward. All right, Dwight, thanks. I'll speak to you tomorrow.
All right, see you tomorrow, Mark.